$500,000 and you put $50,000 down. You borrowed the other $450,000, which means you are leveraged 10 to 1. But if your house drops in value by just 10%, that wipes out 100% of your equity. That's what leverage does. It amplifies when it's working, but it also does the same in reverse. Now zoom out and apply all of that to the whole economy, and here's what it looks like. The homeowner is leveraged, right? They have mortgages. Most people in America do. But it's not just homeowners. It's also the banks that gave you the mortgage that is leveraged, because even the banks borrow money to lend it to us. The private credit fund that's holding the packages of those loans is also leveraged. The insurance company that invested in that private credit fund is leveraged. And the government that's sitting above all of this is the most leveraged one of all, to $38 trillion. So every layer of the US debt-based system is borrowed against the layer below it, kind of like a tower of playing cards. It might only take just a couple of industries and jobs to be displaced, which kicks off that chain reaction. Okay, but who am I talking about? Who is going to get displaced? Well, that would be the white-collar jobs. Here's an interesting chart that was floating around online about which jobs are susceptible to AI. Jobs in office administration, business and finance, computers and math, and education. But it looks like we're starting to see this even in the real economic data as well. We're seeing huge declines in finance and insurance jobs, in the information sector, in the professional and business services. And all this leads to what? Tighter lending, falling asset prices, volatility in the market, and uncertainty, because we just don't know what's going to happen.